to you about corporation tax and multinationals, in particular how we go about taxing multinationals and this sort of quite prominent issue in the media over the last few years of multinational corporate tax avoidance. So a little bit of context here. Why is this such a big issue? Well, so now it's definitely true that most of the world's largest companies locate different parts of their businesses in different countries. So, for example, they may get their inputs from one country, manufacture their good in a second country, and then sell it in any number of other countries. So data from the early 2000s, how prominent is this? Well, so this was just in the early 2000s that nearly 40% of all imports and exports into and out of the US were intra-firm transactions. What I mean by that is that's two members of the same multinational group trading with one another. So that's a huge proportion of US trade isn't happening between companies, it's happening within companies. And why is this important? Well, so multinational firms are considerably more mobile than other firms. So I mean two things by that. Firstly, they're more mobile in terms of where they produce. Because they already sort of have bases in lots of different countries, it's much more easy for them to move their production from one country to another. But also, they have to allocate or they have to report their income in certain places for us to decide where we tax their profit. And because they've got bases in lots of different countries, it means that they've got some flexibility over where that income gets reported, or at least that's the perception. That's what we're going to be talking about more today. And it's difficult to work out where the profit of multinationals should be taxed. That's what I'm going to be trying to explain to you today. Really, that this stuff is very difficult, it's very hard. But what this does do is it creates avoidance opportunities. So there's been considerable public interest in this sort of perceived avoidance behaviour of multinationals. A number of firms have sort of been named and shamed in the media. In actual fact, and I'll go on to talk about this later, none of these cases are sort of clear-cut. And that's actually a big issue with avoidance, that in general it is a grey area. So a lot of these complaints centred around the sort of quote, a very large sales figure for the UK, but a very small tax take. And we'll talk a bit more about that in a moment. So this considerable public interest has sort of fed into the political sphere, and politicians have taken notice. So the Public Accounts Committee is a select committee of the House of Commons, and they've sort of questioned a number of sort of bosses of these big multinational companies about their UK tax reporting, and also have come out and said, we think this company is doing something that's not quite right. And so in the last election, all parties were tough on avoidance, and they were promising to raise between sort of 5 and even 30 billion, some parties, through anti-avoidance measures. Now, that wasn't just corporate tax, that was also sort of income tax and high-income individuals. But certainly a lot of the public focus is on where the sort of perceived money can come in from large multinational firms. I mean, it's not just a UK issue, it's also a hot topic internationally. So BEPS, base erosion and profit shifting. So base erosion, where basically a firm designs its activities so that that money doesn't get taxed anywhere. And then profit shifting is more where you report more income in a place with a lower tax rate, so that your overall amount of tax goes down. So there's a project by the OECD, basically a multilateral attempt, so lots of different companies getting together to try and redesign the tax system in the best way, to try and basically tax multinationals more effectively, or in a way that's perceived to be more efficient and fair. Okay, so what am I going to do today? So firstly, I'm going to actually lay out what we actually mean by tax avoidance. So that's both in terms of how we work out how much tax these companies should be paying, and the ways in which sort of firms might go about avoiding that sort of correct amount of tax. And I'll also have a quick look at some estimates of how much is going on, where the answer really is that we're not quite sure. Then the second bit, which is sort of the really meaty economics of this, where we look, actually, what's an economist's perspective on this stuff? How should we think about it? We'll have a look at some economic theory and some evidence there. And then finally, very quickly at the end, just thinking about policy debates and challenges going forward, in particular as the UK and other governments tries to sort of crack down on what they perceive as large avoidance activity. But firstly, what do we mean by tax avoidance? So the definition of tax avoidance from HMRC is bending the rules of the tax system to gain a tax advantage that Parliament never intended. It involves operating within the letter but not the spirit of the law. Now straight away I think this sort of explains really where all of the complexity and the ambiguity is coming through avoidance, because the spirit of the law is sort of inherently subjective. what I think the spirit of the law is. Maybe different to what you think, maybe different to what Starbucks thinks, maybe different to what HMRC thinks. And because, as it says, it's within the letter of the law, it's not sort of a hard and fast, are they doing something wrong or are they doing something right? It's what's the spirit of the law, and that's much more a sort of moving concept, and also a sort of matter of degree. And this is where a lot of the complication is really coming from. So it's distinct from evasion. So to give a very quick example of the difference between evasion and avoidance, if you think about a plumber who comes to your house and fixes your boiler, if you pay him cash in hand and he never reports that money to the tax man, that's evasion, that's illegal. If instead he's, rather than being a self-employed individual, has incorporated, so made himself a small company, which there are perfectly good sort of commercial reasons to do, but it may also have the effect of reducing how much tax he has to pay. That may be considered tax avoidance. So one is very clearly against the letter of the law, it's illegal. The other one is much more ambiguous, it's much harder to tell. So before we think about what tax they're avoiding, we need to think about actually what should they be paying in the first place? How do we determine the tax liability? So for a domestic company, a firm that does everything in one country, this is quite easy. So you have their sales, all of their income, minus certain allowable expenditures. All of their wage costs get deducted, some of their investment costs. Interestingly, if you look here straight away, you can see that quoting a large sales figure and then a relatively small amount for how much tax they're paying, that's not proof of something dodgy going on at all. Because if they've got high expenditure, then they could have high sales but very low profit. So straight away, it's a lot more complex than saying there's a lot of sales, therefore there should be a lot of tax. There are other things going into that equation. But for multinational companies, obviously, it's even more complicated because they're holding different stages of their production process in different countries. And we can't tax that profit everywhere. So in a lot of, say one company operates in 20 jurisdictions. All of those jurisdictions will think that they have some claim to the profit that that company makes. But we can't be taxing that profit 20 times over. So what we need to do is come up with some way of allocating that profit between countries, and that's what the international tax system tries to do. But where those profits should be taxed is sort of inherently pretty complicated. And there's not an obvious, intuitive right answer as to where it should be. So you may think it should just be where the sales are. But then what if all of the activity that created that was in another country? That other country would feel like they had some claim to that income. So the principle of the international tax system in general is to try and tax profits where that profit or value added has been created. So if the reason that a company makes so much money is because they've got a brilliant sales team, then the location of that sales team is where the profit should be created. So now I'm going to look at a sort of simplified example to try and get at how this actually happens in practice, and to think about how we would maybe do it. So if you've got a coffee seller in country A, then there's also someone who supplies their beans in country B, and someone who provides the trademark in country C. So we're thinking of these are all part of the same multinational group. They're all one company. So let's think about this. First, so they're all one company, but say they were all located in country A. So the trademark owner and the bean company and the coffee seller are all just one company located in one country. Well, then it would be very easy to work out their taxable profit because they'd have a certain amount of sales from selling their coffee, and they'd also have paid a certain amount to produce the beans, they'd have paid a certain amount to develop the trademark, and there would be some other sort of wage costs deducted, and that would be how much tax they have. So if it's just a domestic company, it's very simple. Now think about, okay, so they're all in 3 different countries, but say that the coffee seller is just a different company to the trademark owner and the bean company. So they're operating in 3 different countries. They're 3 entirely separate groups. So how would we work out the coffee seller's profit? Well, again, it would be quite easy because they would have those same sort of wage costs as before. But they would also, because they're separate companies, they would have to pay the bean company for the beans, and they would have to pay the trademark owner for the rights to use the trademark. And then you would deduct those sort of transfers to those other companies. So that's just costs that they've paid in developing their in developing their coffee and getting people through the door, and that would be their taxable income. So if they're all entirely separate companies, it's also quite simple. I mean, the approach of the international tax system is to say, okay, we're going to tax you as if you were unrelated parties. So we know that the coffee seller and the trademark owner and the bean company, they're all in the same group. But for the purposes of the tax system, we're going to say, no, you're not. And what the coffee seller has to do is pay a transfer price for the coffee beans. So basically they are paying a price, even though in practice all they're doing is taking the beans from another part of their multinational company. For the purposes of working out tax, they have to pay a transfer price to the bean company in country B. And the principle of the international tax system is that this transfer price should be an arm's length price. And what that means is it should be like the going market price. How much would the coffee seller have to pay for those beans if it were not in the same multinational group as the bean company? Say they were just separate parties, say they would have to pay £100. Then that is the cost of the transfer price. That's how much we reduce profits in country A by. And you can see how this is linked to that principle of we want profits to be taxed where value is created. Because if the reason that the coffee seller is making all its money is because the beans are really, really good, then that means those beans are very valuable and the transfer price they'll have to pay will be higher. That's going to reduce the amount of profit that goes to the coffee seller and increase the amount that goes to the bean company. So if we have sort of efficiently and correctly priced transfer prices, this should achieve the effect that we want of taxing profit where the value added, where the profit is created. Okay, so that may seem pretty good, but in reality, this stuff's very complicated. So what I'm now going to do is run through, quite briefly, 3 different ways in which firms might avoid tax, basically where they can exploit ambiguities in the tax system and reduce their overall tax liability. So firstly, I said that it's all good if we can work out the correct transfer price. We can work out that sort of market price that they should be paying, but in reality, that could be really hard. So in a lot of cases, particularly if you think about trademarks, if you think about a company logo and the rights to use that logo and the value of that logo, that's only really transferred within a group, within a multinational company. There is no going market price. They're not also selling it to other people. So that means that ascertaining the correct arm's length price for the right to use the trademark is really hard. We don't have that sort of natural third-party example to go to. And that means there's a certain amount of uncertainty. And actually the company may not know entirely how much value is created by the trademark versus some other aspect of its business either. So there's real ambiguity here about what the correct transfer price is. And so if we don't know what the correct transfer price is, then that gives some leeway to the company to sort of adjust or change that transfer price a little bit. Okay, so assume now that country C has a really low tax rate. So if profits reported in country C, it pays hardly any tax, whereas country A has a significantly higher tax rate. So if you think now what the company can do, if there's some flexibility, there's some uncertainty about the transfer price, what they can do is slightly overestimate what the transfer price should be. So there's a price paid from country A to country C. That's going to reduce the amount of profit in country A, increase the amount of profit in country C. Now the overall profit reported by the company hasn't changed. They've just sort of shifted it between 2 countries. But what they've done is they've shifted some of that profit from a high tax country to a low tax country. So their overall amount of tax they've got to pay has just gone down. So that's profit shifting. Okay, so that's one way in which they might avoid tax. And again, as I say, that's a really difficult one to identify because the only reason they may have some flexibility to do it is because we really don't know what the correct arm's length price is there. And there are, and I'll go on to this briefly in a moment, there are sort of mechanisms to try and prevent this stuff happening. So here's a second tax avoidance strategy. So even before we had that structure before, companies are free to locate their intellectual property, like their trademark, in any jurisdiction that they like for good commercial reasons. So they can choose to locate that IP separate from where the R&D activity took place. We may think that the true source of that, of sort of the value to that trademark is the R&D activity underlying it. So say that happens in this high tax country over here. But then what the trademark owner can instead do is locate it in country C, where again, as we said, there's a lower tax rate. So even though, again, this is perfectly legal, they're not doing anything against the letter of the law, but by choosing to locate that and manage that trademark from somewhere different from where they created it in the first place, we may think that they're artificially reducing how much tax they should pay, because instead of those royalty flows going to the high tax country, they're going to the low tax country. That's what that says. Okay, so the final one, intragroup loans, which would say be a loan from one part of a multinational group to another. So there are perfectly good reasons why you may want to have intragroup loans. If, for example, part of your business does lots of investment and another part gets a lot of sales, you may want to have a loan from the one with high liquidity to the one that needs to do lots of investing. So interest paid on debt is deductible. So if I take out a loan, the interest I pay back, I get to deduct that from my taxable profit. But interest earned on loans counts as taxable income. So say I give you a loan and you give me some interest, I have to pay tax on that interest. So what this structure here is a loan from a company in a low tax country to a company in a high tax country. And what that means is there's a corresponding interest payment from the company in the high tax country to the company in the low tax country. And what that does is it reduces the amount of profit in the high tax country because interest paid is deductible, and increases the amount of profit reported in the low tax country because interest paid to you counts as taxable income. So again, they've not changed how much taxable income they have overall. What they have done is shifted it from a high tax country to a low tax country, again reducing their overall tax liability. And again, because there are legitimate reasons for intragroup loans, it's really hard to separate the ones which are for good, sound commercial reasons, the ones which are tax motivated. And in many cases, again, it's going to be a matter of degree. It may be partly commercially motivated and partly tax motivated. Okay, so those are the three ways in which, three little examples of ways in which firms might avoid tax. It's not like authorities are just sitting there doing nothing. They know this stuff exists and they have rules to try and stop it. So on transfer prices, the tax authority observes what the transfer price is paid, and they can appeal it if they don't think it adheres to an arm's length principle. On intragroup loans, there are a number of things to try and prevent companies taking advantage of this. So there are thin capitalization rules, which basically means that you can't hold loads of debt if you're really small. And the UK also has a worldwide debt cap that basically limits the total amount of deduction you can get from paying interest. So both of these cases, this prevents firms just sort of doing whatever they like to try and reduce tax, but because there's enough uncertainty there, it's not black and white in any individual case. It can't eradicate the avoidance opportunities. And then finally, there are controlled foreign company rules, which I don't have time to go over today. Okay, so those are sort of the broad ways in which firms may avoid tax, and also ways in which jurisdictions may try to stop them. But that doesn't really give a sense of scale. We've got these examples, but how much avoidance is there? So we do have this strong anecdotal evidence that it does happen. These high-profile cases exposed in the media. And even though, as I say, they're not black and white, it's not obvious that firms are doing something wrong, they do at least indicate that avoidance, or at least structures that are designed in some way that have the effect of reducing a tax liability, that they are prevalent, that there's quite a lot of companies using things like this. But the difficulty is it's really difficult to identify avoidance. Almost by definition, if it was easy to identify, then HMRC would be sort of cracking down on those cases. So there is some economic research that has found evidence of the existence of avoidance, but not really the scale. And so a lot of those cases would look at sort of data of quite a lot of transactions, so quite a lot of transfer prices, and can say, okay, on average, prices are lower when they're with low tax jurisdictions. So that's evidence sort of in aggregate that there's some tax avoidance going on, but that's not enough to indicate, to sort of identify any individual case of avoidance, which is what you need to do if you're trying to prosecute this stuff or prevent it. And this means that really there's considerable uncertainty about the scale of avoidance in terms of how much revenue we're actually losing. So HMRC estimates a tax gap every year for every tax, which is basically how much tax were we owed that we didn't pick up. And they reckon it's about 4 billion on corporate tax. Only about 1 billion of that is actually multinational avoidance. So that's to put it into context, corporation tax revenues are about 40 billion. But then there are other people who would consider broader scope and often have sort of slightly cruder methods, and they come up with very large numbers, sort of 12, 13 billion pounds as to how much is being lost. The reality probably lies somewhere within this range, but it's really very hard to say where, just because it is so difficult to identify. It is to an extent subjective as to what counts as avoidance and what doesn't. There are some things that you may consider perfectly legitimate that someone else would consider as tax avoidance. So really the answer on how much avoidance is we just don't know. So that's the first bit. So we've laid out what we mean by tax avoidance, had a look at some of the ways in which firms avoid tax. And now we're going to sort of take an economist perspective on this stuff and say, well, is avoidance all bad? Like, what does an economist, what does economic theory, what can it inform us on this stuff? So I'd say that the common view, which is probably a bit of a straw man, is that sort of it's rich companies and their shareholders who benefit from avoidance to the detriment of everyone else. We're losing out on tax revenue so that we're getting less stuff and they're getting more profit. So how are we going to think about this? We're going to think about avoidance as effectively a lower tax rate for multinationals. Because for any amount of tax they pay, they don't sort of avoid all of it, but there's a certain amount that they can avoid, so they pay less tax than, say, a domestic company would in the same situation. So that means the question really here is who bears the burden of corporate tax? This is quite a common thing in public economics, of who bears the burden of a tax, and that's not who's actually paying it over, but so it's the company paying it over, but whose economic welfare is actually affected by this, and that's really who's bearing the burden of the tax. So one very important principle to bear in mind is that taxes are always borne by people, not companies. So the people who could be bearing the tax here, so you may think it's pretty obvious, it could be the shareholders, because they're getting lower profit, or it could be the workers through lower real wages, or it could be consumers through higher prices. Those are sort of the three potential groups here that could be bearing the burden. And so what I'm actually going to show you now is a very simple economic model that is actually quite counterintuitive and actually suggests that maybe workers are bearing most of the burden of the corporate tax, which is actually going to change the way in which we think about avoidance. Yep. Okay. So the model we're going to have here, just very simple supply-demand diagram, is a small open economy with mobile capital, so a shareholder can put their funds in any country in the world, and perfectly immobile labour, so I can't go and get a job in the US. So let's firstly just have a look at the diagram. So the first thing to see is that so this marginal return to capital is on the y-axis. So that's how much return would I get if I invested an extra pound in the UK. First thing to see is we've got downward sloping supply. And why is that? Well, so if you think about it, if I'm someone coming to a country for the first time, what I'm going to choose is the most productive project to invest my money in. Then the next person comes along, pick the next best productive project. That means that as you go on, the marginal project is going to be less productive because all the good ones have been taken, basically. So you've got downward sloping supply. And so this is, R1 is going to be R star, which is going to be determined in the world market. And what that means is that the marginal rate of return, the marginal return to capital has got to be the same everywhere in the world. So understand why that has to be. Consider first, say the UK has a lower marginal return to capital than the rest of the world. So that would mean that they were here somewhere. Well, then there is a whole group of people in this line here who are basically getting a really low return to their capital. They could take that money out and put it in another country, and they would get, say they could put it in the US where the return is R1, which is the world return. And then that would mean there'd be less capital in the UK. So that reduces capital, and there's always an incentive for people to take their capital out until the marginal return is equal to the world return. And equally, say the UK marginal return was higher, well then there are people in the US who can move their funds, who are only getting the marginal return in the US, who can move their funds over here and get a higher return here. So for there to be equilibrium, for no investor to have an incentive to move their funds, it has to be the case that the marginal return is the same everywhere. Okay, so we're considering this at the moment as a no corporate tax world. We've got no taxes. What we're going to do now is introduce a corporate tax. And so what that's going to do is so we had the return R1, but now that we've got a tax, that means that R1 isn't worth quite as much to our investor anymore, because the investor gets the pre-tax return, but then it gets taxed. So now what happens is what we require, again, is still the post-tax return. What the investor gets is the same in the UK as everywhere else. Now that there's a tax on how much they get, they need to get a higher return for there to be no incentive for them to move. So what that does is it increases the required pre-tax return to R2 rather than R1. So this is basically the value of the tax in here. And that means there's a whole group of people here who are now getting a lower post-tax return than the going world rate. So they can get a higher return somewhere else. So what they're going to do is they're going to move their funds. And that's going to reduce the amount of capital in the UK. And that's going to continue to reduce it until the post-tax return is again the same as the world post-tax return. And that's all that says. Okay, so who's bearing the burden here? So we've seen, shareholders are still getting the same marginal return as they did before. Not in the UK, now elsewhere, but it's still the same for them. But does that mean that there's no burden at all? Well, no, all it means is that shareholders aren't bearing the burden here. And actually what's happening is we've now got less capital in the UK, and wages are equal to the marginal product of labour, sort of fairly standard economic theory, or they're at least proportional to the marginal product of labour. We've now got less capital. That's going to mean that labour hours are less valuable. I can do less when I've got fewer machines to work with. So that's going to reduce the wages. And actually, in this small open economy, in this sort of stylised example, labour's going to bear all of the corporate tax. All of the burden, all of the economic welfare loss is going to go to workers through either lower wages or higher prices. Okay, so this is a stylised model. And so we don't know what the true burden on labour is. Actually, it's just incredibly hard to identify this stuff, and plenty of researchers have tried. But so some things that would sort of vary how much was borne by labour versus capital. Well, so if the country's large, then they're going to affect the world's, then the introduction of the tax here is going to affect the world's marginal return. If capital's less internationally mobile, then you can have a slightly lower return here than elsewhere. And that's going to mean capital bears more of the tax. But it's just a very hard question to answer empirically. And so there have been some attempts, which I'm not going to go over in the interest of time here. So this just shows that so people have developed sort of economic models, theoretical models to try and work out what the burden would be. And they all make slightly different assumptions. Actually, they all look like pretty reasonable assumptions, but they can lead to hugely different estimates of how much of the burden is borne by labour. So I'm not coming here today and telling you that corporate tax only affects workers' welfare. That's not at all what I'm saying. All I'm saying is it's very uncertain. And it's very likely that it's not going to be borne purely by shareholders, just because shareholders are more mobile than workers. So they're able to avoid the tax more easily by moving abroad compared to workers who are more fixed. Okay, so just to sum up this little section, why is it important? Well, so whoever bears the burden of the corporate tax, sort of by definition, shares in the benefits of avoidance. Because if there's lower tax, there's less burden. So if whoever's bearing the burden is sort of getting some of the benefit from avoidance. So if capital's bearing most of the burden, which I guess is sort of the prevailing wisdom that shareholders are the ones who are benefiting, and then the shareholders, as you say, are the ones who are benefiting most from avoidance. But if instead it's labour who's bearing most of the burden, so it's actually workers who are suffering, then if we crack down on avoidance, that could mean lower wages, because there's some feed-through mechanism there. If companies are paying higher tax, some of that may get passed on to workers. And so consumers, if you clamp down on avoidance, consumers will benefit from higher tax take, because that's more funds that can be spent on public services, or less tax that can be raised from them elsewhere, but they may also incur a cost, which could be lower wages. So as I've said, the true incidence is really uncertain, but this mobility of capital implies that at least part and possibly a substantial amount of that burden is going to be on labour rather than shareholders. Okay, so second part now, a second bit of economic theory. So most taxes distort behaviour. right? So if I get an income tax, I may work a bit less, I may not. If a company gets paid has to pay a tax, they may invest less or they may move. And in general, there's also, when there's this distortion, there's sort of an efficiency loss associated with it that we consider like the deadweight loss of the tax. And that's in some sense proportional to the size of the behavioural change. So there's a bigger cost if a firm reduces investment by a lot compared to if a firm just reduces investment by a little. So corporation tax is considered especially distortionary because it affects the investment decision of all firms and also affects the location decision of multinational firms. So actually what economic theory says is maybe we want to tax more elastic stuff less. So we want to tax the stuff that reacts more less because there's more of a cost associated with taxing them. And actually, so these multinational companies are just an example of these more elastic activities. There are more mobile firms, so if I tax them, they may respond by moving all of their business outside the UK, whereas a domestic company may simply reduce their investment by a little bit. So actually there could be efficiency gains to charging less tax on these more mobile activities. And so maybe sort of avoidance is sort of limiting this distortion in quite an efficient way. Maybe the firms that are more mobile are able to avoid the tax more efficiently and so they pay less tax. But maybe that's sort of efficient because if you take the extreme example where a firm just reports income wherever the hell it wants, then its production decision isn't going to be affected by the tax at all because it will just produce in the place that it's best to produce in. And then it won't worry about the tax, it will just pay it somewhere else. So in the extreme at least, this is a way in which maybe avoidance is sort of efficient. Now this may sound like I'm sort of in favour of avoidance, but actually these are just some points from economic theory that suggest that it's at least a bit ambiguous. But suggest that is not to say that avoidance is costless. So even if we may want to charge mobile activities a lower tax rate, avoidance is a really inefficient way to do it because they spend so much money and there's so much inefficiency involved in sort of tax planning and sort of routing specific funds through different countries to try and limit liabilities. And that stuff is clearly inefficient. And it's not like there's not a cost to getting lower revenue from multinational firms. Because if you allow more avoidance, that means you've got less to spend on other stuff. And we may think, so you've got less to spend on public services, or you may have to increase other taxes to make up for that shortfall. And those taxes have got their own distortions associated with it as well. The final thing that it could also do is there may be this distortion in competition between domestic and multinational firms. So if I'm John Lewis and I have to pay tax in the UK, and I'm competing against another company that doesn't pay as much tax, maybe there's an inefficiency there that sort of distorting competition towards the multinational companies away from the domestic companies. All of this stuff is very difficult to quantify, but it's stuff that economic theory can sort of inform us about how we should think about avoidance. So just to sum up this section, so it's really not clear who bears the burden of the corporate tax. But due to the sort of mobility of shareholders' funds, it's unlikely to be purely on shareholders. That's really something to keep in mind as you go forward thinking about multinational tax avoidance. And actually, taxes in general is who's actually paying here. It's not to sort of be fooled by who's handing over the tax and think, okay, they're the ones being hit. But actually try and think about sort of theoretically who's actually going to bear the burden of this tax. So it's also efficient to maybe efficient to tax more mobile activities less, but avoidance is not costless. So what's the conclusion of all of this? Well, really what it means is the welfare implications of avoidance are ambiguous. And reducing tax avoidance is not some free lunch. So it's not like a jurisdiction could successfully crack down on avoidance, get an extra 20 billion in revenues, and no one will pay the price. That's not the way it works. So there will be costs involved. And that's principally because shareholders are not the only beneficiaries. Okay, so I've got the last few minutes now just to go through some policy debates in corporate tax. And particularly, so very recently the OECD has just published basically recommendations for what countries should do to their tax systems to reduce the problem of avoidance. So what we've really shown so far is that this is a really difficult policy environment. It's really hard to work out how much tax should be being paid. There are lots of sort of ambiguous welfare implications. But policy still has to be made. Countries still have to try and deal with this stuff. And in recent years, there's been an increased emphasis on multilateral action. Lots of countries doing stuff together rather than just one country acting alone. And the theory here is that because a lot of the advantages that companies gain are from sort of taking advantage of mismatches between different jurisdictions, if you can get more uniformity across those jurisdictions, then maybe you can reduce the problem of avoidance. And so the OECD BEPS, which is base erosion profit shifting, as I said before, is sort of an attempt at this. And there are 15 action points. So things like transfer prices, which we've talked about, interest deductibility, which we've talked about. So they reported in late 2015. And while it's going to take a while for us to know what the real effect is, broadly these are sort of piecemeal improvements rather than like a silver bullet fundamental solution to the problem. And that's because they've sort of kept with the existing system. So we've still got transfer pricing. So that means that we've still got ambiguity about what the correct transfer price is, just to take one example. Okay, but interestingly in this area, there's really a bit of a tension in corporation tax between this cooperative desire to sort of work with other countries and reduce avoidance, but also the UK especially has been very keen to emphasise the competitiveness of its regime. So in the last Parliament, the main rate of corporation tax was reduced from 28% to 20%, and it will be 18% by the end of this Parliament. And so that's a form of tax competition, right? That's the government trying to incentivise companies to come here rather than elsewhere. But then there's not a clear distinction between this sort of legitimate tax competition and more harmful tax competition. So, for example, the UK has a patent box, which basically means that if you get income from a patent that's located in the UK, you pay less tax on that. Is that sort of harmful tax competition, or is that legitimate? And we won't go over that second point. But really, the point I'm trying to make here is there's an inherent tension in corporation tax between being internationally cooperative and trying to reduce avoidance, but also being internationally competitive. Because what one country sees as avoidance, another country may see as their legitimate competitive advantage. And actually there's not a clear distinction between tax competition to do with avoidance, so it's basically making it easier for firms to avoid tax by locating in your country, versus more legitimate means such as a lower tax rate. From an economic point of view, it's not really clear what the difference is. They're both reducing the tax liability. Okay, so just to sum up. So there's strong evidence that multinational avoidance happens, but it's really hard to have even an educated guess about how much, at least a particularly good or tight bounded educated guess. The welfare implications of avoidance are nuanced, and that's because economic theory suggests corporate tax isn't just incident on capital, and it may be efficient to tax mobile activities less, but there are costs to avoidance. For example, tax planning and lost revenues and other things. And in a really difficult policy environment, countries are trying to respond to avoidance with multilateral action by working together. But there's an inherent tension between wanting to work together and wanting to improve the competitiveness of their regime. Okay, so I've got a couple of minutes if anyone has any questions. Yes?
Is there any real reason to have a big sort of in this race to the bottom about corporate tax rates now going down to 18%? I know we're trying to compete with Ireland, etc. But I mean, certainly the tax rate used to be 25, not 30%. I mean, is there,
Sure.
Is there any sign that this sort of race, this competition on corporate tax rates is actually beneficial?
Well, so I guess the problem is that the competitiveness of a regime is really a moving target. So if, say, 30 years ago, 30% was a really low rate, now 20% is considered a low rate. And so the problem is that there could be, so if, say, countries sort of got together and agreed not to reduce rates, that there could be some sort of advantage to that. But when other countries are also reducing rates, it's not clear that the UK keeping a high rate versus getting involved in this race, as you say, what you call a race to the bottom. It's not clear that that's the right policy or the wrong policy. The one thing I would say is that people have been predicting sort of the demise of the corporate tax and this race to the bottom for a very long time. So corporate tax rates started going down sort of 35 years ago and are considerably lower than they were then, but they're still a long way from zero. So the UK rate is still 18%, where there are people 30 years ago suggesting that maybe it would basically be nothing by now. And actually, corporate tax revenues throughout that time have sort of continued to increase, or have at least stayed stable. So the honest answer is it's very difficult to know, and there's not sort of an obvious way of quantifying one policy versus another.
Is the very idea of competition between tax regimes
Self-defeating?
good?
Well, so it's an interesting question. So
Because obviously when a tax regime is more competitive, it attracts more companies, but it's
Yeah.
taxing less.
yeah,
So it affects the provision of services.
yeah, exactly.
rather
So
than meant to provide.
And so if you think about, say every country had a tax rate of 30%, and then they all got involved in this competition, then they all had a tax rate of 20%. No country is more competitive than it was before, but they're just raising less revenue. So actually, there's a literature that suggests that really this tax competition is quite harmful. We should be trying to limit how much goes
So
on.
essentially, the more it goes on, labour will end up bearing all the costs you're talking about with companies. If it reaches zero, for example,
Mhm.
companies will still exist and they'll still be profitable, they won't be being taxed. But then
So
labour
they're
will be paying for them.
Through other means.
Yeah.
So then you'd need other taxes or lower
Yeah.
services, right? Yes.
You mentioned how corporation tax is always in the end borne by shareholders or
Yep.
consumers or employees, and some economists have argued that we should get rid of corporation tax on those
Yep.
grounds because the corporations themselves don't pay it. Do you think that's a good idea, or could that have unintended consequences?
So there are a few reasons why the corporation tax system exists and why getting rid of it would actually be quite hard. So for one thing, it's a backstop to the personal tax system. So it stops me just incorporating, becoming a business and paying, and basically my income being profits and paying nothing on that. And so the other thing, the other ways that people have sort of justified the corporation tax is that that because companies are benefiting from, say, the fact that we have a secure business environment and we have good roads that they can ferry their goods on, is a reason why corporations should pay, and particularly that foreign shareholders in corporations should pay. And on a purely practical ground, the corporation tax is raising us 45 billion a year. Just to get rid of that would have some possible efficiency benefits, but also have a lot of costs as well. And that's always I mean, if we were just looking for the most efficient, economically efficient system, you wouldn't have many taxes. But that's not what we think, because we have a value to public services and public spending. So yeah, I certainly wouldn't advocate just scrapping the corporate tax. Yeah.
What you just said about the foreign shareholders having to pay a tax for the services, is there not an argument for saying that if you're a domestic business and as an individual you pay tax towards the government having the services, you would have a lower corporation tax for a domestic business and then higher on foreign business?
So I suppose the difficulty is that both foreign and domestic companies, particularly if they're listed, could have both foreign and domestic shareholders. And then you're getting into this difficulty that you're sort of discriminating between companies again. And there's not a sort of, there's not a clear reason why you want to favour one over the other in that case, at least. Sure, last question. Yeah.
Do you reckon it would ever be possible to have an international cooperative corporation tax system? Because isn't this just like the prisoner's dilemma where one country will always have the incentive to have another sort of corporation tax together?
So it's interesting you say that. So the EU are quite keen on the idea of a consolidated corporate tax base, which would basically be that at least within the EU, corporation tax will be calculated on the profit as a whole and then sort of be apportioned to different countries in a certain way, which is getting there. I think in reality, we just had this OECD project that's gone on for 2 years, and this was sort of the maximum that countries were willing to agree to. And really, there's not nearly enough cohesion between countries and agreement about what they want to achieve, and for that to really be realistic. But it would certainly get rid of a lot of the tax competition issues that we've got here, because if they're all working together, then there's not a sort of beggar thy neighbour incentive there. Great, thank you very much. And I will pass over to Barrett.